The oil price matters because it literally filters into pretty much everything that is ubiquitous with life. In fact, most of us listening or watching to this podcast right now have invariably got oil on them.
There's a massive disruption and also massive uncertainty arising from, how long is this going to go on? No doubt we're looking at easily the biggest disruption that I've encountered.
It's a much longer day recently, that's for sure. I have not slept in the office, nor do I want to, but certainly the days are a bit longer.
The price of oil is on a wild ride. Not only is it going up fast, it's also very volatile, rising and falling along with headlines linked to the war in the Middle East. Now, we're not the right podcast to discuss the human cost of this or of any war, and we're not discussing geopolitics today. But what happens to the oil price matters. It affects the global economy, inflation, and ultimately politics everywhere. Oil prices shot up 60% in March, but sank again sharply on the morning that we're recording this. So today we wanted to unpick what moves oil prices and how the global oil market works. To do that, we've got two of our top experts, both of them joining us from Singapore. Chris Kenny is head of energy trading, and friend of the show, Michael Shrey, senior research analyst, is joining us again to give his perspective on this market. I'm Michael Steen, and welcome to This is Deutsche Bank, the podcast for the news and trends shaping the world of banking and finance. Today is the 1st of April. Let's get started. Chris, Michael, a very warm welcome to both of you. And Chris, if I can start with you, how is the oil price set and why does it matter?
That's a great question. Ultimately, the oil price matters because it literally filters into pretty much everything that is ubiquitous with life, whether it's transportation and transport and transit. Other obvious things would be resins, lubricants, fibers, and stuff like that. So it is a piece and a facet, really, of everyone's daily life. In fact, most of us listening or watching to this podcast right now have invariably got oil on them, whether it's cosmetics, hair gel, the plastics in your glasses, and so forth. The pricing is set, most commonly we see two exchange variables, Brent in Europe and WTI in New York. So we see those each and every day, but the vast bulk of the pricing takes place in the physical OTC market, and that's determined each and every day at various locations around the world. So Asia has one, Europe has one, and the Americas have one at different time sets during the day to allow for those prices to occur. Yeah.
So there's actually different oil prices depending on location, just to understand that a bit more?
That's exactly right. So the more particularly the finished products are the big ones that are really valued and assessed, as we say, OTC. So those refined products like diesel, jet fuel, and gasoline. And you have a center of process and price capture here in Asia, what we call the Singapore window, which occurs at 4:30 p.m. here. And we have a similar window called the London window. It's all administered by an independent pricing agency, also at 4:30. And then you have a similar effect in the Americas with 2:30 New York time.
Okay, so when we talk about the oil price, there's actually a lot behind that. But mostly, am I right? When we're talking about the oil price, we usually refer to the Brent price, or how do we look at that?
That's right. I think most people commonly refer to Brent and certainly to an extent WTI. Lately, Dubai crude, the key grade in the Middle East and the benchmark for the Middle East, has certainly got a lot of press vis-a-vis what's going on with the war in Iran. But when we think about what impacts us and what we really feel and live from a day-to-day basis, it then becomes those refined fuels and how do we get to those products? And there's a certain value add process in the refinery with which we have to tack on those charges to make those prices. And of course, then we see that at the pump, or we see it in our airline fares and our train fares. And most recently, a lot of the rhetoric around, certainly in Asia, and you've seen it in Europe as well, announcements of those ticket prices going up because of these fuel surcharges. So those finished products are really what impact measures beyond the commodity space, be it equities or inflation.
Okay, thanks a lot. So Michael, if turning to you on this one, we've been focused, obviously everyone has on the Strait of Hormuz recently, which is currently closed to most shipping due to the war. but is where something like 1 in 5 barrels of crude oil would normally be shipped through. Does disruption in the strait cause sharper volatility in prices in some regions more than others, or how do you look at that?
Yeah, absolutely. I mean, just to kind of give you a picture, it's I think it amounts to about 13% of global oil demand. So it's not completely shut, and there have been ways of diverting supply around that. So it's not as bad as it could be, perhaps, but yeah, there's a massive disruption and also massive uncertainty arising from, how long is this going to go on? Which is, the amount of supply that's disrupted is a linear function of how long this goes on. So, and then thinking about geopolitical risk premium, it basically derives from how long people think it will go on and how messy it could be in terms of restarting commercial traffic through there. But no doubt we're looking at easily the biggest disruption that I've encountered.
I mean, on that, there's been some comparisons to the 1970s and the oil crisis then. Chris already pointed out quite how ubiquitous oil is in our lives. One thing that has changed, though, I suppose, is that we're a little less dependent on oil than we were, although maybe not as much as you think, because as Chris already pointed out, this is about far more than simply fuel. But how do you see that comparison? Is this worse than the 70s or the same, or is there a way of quantifying that?
Yeah. There are lots of interesting comparisons we can make. One is certainly that there's a geostrategic aspect to what's going on. I know that's not our focus now, but one kind of regional consequence is that the impact on supply is very focused on certain regions where, in 1973, it was an embargo targeted against countries who were supporting Israel in the Yom Kippur War. So, it most directly affected the US, UK, Canada, Japan, and the Netherlands. And now today, we're seeing most of that impact hitting Asian supply. Because Asia takes about 86% of the, at least of the crude oil exports coming from the Persian Gulf, leaving aside the refined products. So there's a geostrategic aspect to it. There's a very regional focus that's different now versus 1973. And then also, I think as you referred to in your question, there is a certain reduction in the dependence of the world on oil. Although, I would say won't be particularly reassuring to those Asian countries who are most affected. But we can see that in terms of primary energy supply, oil represented 52% in 1973, and now we're down to 34%. And also, the world's economy is becoming much less energy intensive. So 1 ton of oil equivalent in 1973 was required to generate 189K in US dollars of real GDP. And now that same 1 ton of oil equivalent can generate real GDP of 335K in US dollars. So that's a 77% improvement over a long period of time, but still a pretty meaningful improvement.
Absolutely, quite a statistic. And although the price, obviously, of crude oil or oil and oil products is kind of global and you can't really escape it, as you were pointing out, the effects so far have been a bit more regional. So there's been a lot more kind of day-to-day knock-on effects on this in Asia. What are some examples of what we've been seeing?
Yeah, absolutely. A lot of anecdotes. A couple really spring to mind. One is about Indian LPG supply, where the government has tightened supply to restaurants, businesses, and hotels.
That's liquefied petroleum gas, right?
Petroleum gas, right. So used for cooking, and so they prioritize the supply to individual households. And then in Japan, it was reported in mid-March that farmers weren't able to get oil for tractors ahead of planting season. And also city transportation bureaus weren't able to procure fuel for bus operation. And then lastly, there are a number of countries that are talking about shifting power generation from gas-fired to coal, simply because of the rise in LNG prices. We know that Ras Laffan at Qatar Energy has been affected. So countries including Japan, but also Germany, South Korea, and the Philippines have talked about fuel switching of power generation from gas to coal. And also yesterday, Italy announced that it was delaying the closure of coal-fired power plants from 2026 to 2038 on energy security grounds.
Okay, so that actually really genuinely spreading also globally in terms of direct impact. I think we've also heard a lot in the news here on potential knock-on effects for airline fuel and things like that, haven't we? So maybe, Chris, in shifting the conversation slightly to looking at ourselves and your particular job, working for an investment bank. What's our role here? How are we involved in oil trading, and what is it we're helping clients with?
Right. Well, typically, what we engage in is the financial derivative that then mimics a lot of this physical exposure. Because ultimately, you have the client that needs that physical, and we're not going to take that away from them or engage in that. They have that locked up, typically under, say, a long-term contract. Where they have risk is in the pricing of that contract. And this is common across any scope of the investment banking space, whether it's rates, FX, or commodities. We're ultimately engaging in price risk transfer. So that's what we're doing. We have a series, and then the market is well developed in this case, a series of financially settled derivatives that then mimic exactly what these physical products do. So we help mitigate that price risk for them while they still maintain their physical supply or physical delivery, depending upon whether they're a producer or a consumer.
So we're talking about people who are both producing and also consuming the oil, and they need to guarantee that their price stays the same over a period of time.
That's exactly right. So we have two broad buckets. One is producer and one is consumer. And the producers are pretty easy to identify. You read about them in the newspaper, you hear about it, whether it's the North Sea or the shale patch or the Gulf of Mexico, or certainly places in the Middle East. Those names are more than likely to be obvious when you think of oil hedging needs. And for them, it's reflective of trying to secure a minimum price for that barrel, obviously in excess of their cost base. So whether it's through the use of financial swaps or option structures that then give them a floor against prices moving too low beneath their cost base, we then ensure through those use of options that they have that protection relative to what they need. On the consuming side, it's a bit more broad in the sense of which customer base you could be dealing with. As I alluded to earlier, when we think about diesel and jet fuel, and then resins and lubricants and whatnot. So obviously the diesels and the jet fuels, you're dealing with transportation and airlines. As Michael said, even diesel can go down to farmers and farmer cooperatives. And then you have trucking companies, you have bus companies. The post service is a large consumer as well. And then, of course, we have some train services. So all of those groups, which sound a bit diverse, really have the same consumption need, and as a result, that price risk transfer. So there are derivative instruments, again, for these refined products that I spoke about. So we see them coming in to secure price hedges against prices going further up. So what we have seen lately is certainly producers coming in advantageously with these high prices to lock in a very good rate and thus secure a very good rate of return on their own investments and production. And likewise, we have consumers continuing to do hedging, but they're probably staying a bit further away from the front end. And that's actually not a case of them avoiding it. What we do find historically is consumers tend to be more programmatic with their hedging style as opposed to jumping in and out, let's say. And so what you're seeing is because the curve is so strong, and in our language, we say backwardated, the front price is much higher than the longer dated price.
So more expensive to buy now than in the future.
Exactly right. And as a result, given your profiles, given your expectation of, say, business, if you were an airline, if you're selling seats for, say, next winter or next summer, those prices relative to today's prices look actually pretty attractive because they haven't moved much. And in fact, the entirety of the oil curve hasn't been a parallel shift, as we just discussed. So there is an opportunity to afford good value, to lock in some of those price hedges for those consumers further down the curve. And we've seen that.
Okay, very interesting. Now, looking at your own history, I mean, I think you started in in trading, a trader in natural gas, and then you moved over to the oil. How does one get into this sector, and what, and tell me a little bit about what's changed over the years.
Yeah, mine's an interesting story. I left school at the peak of the long-term capital management blow up back at the end of the 90s. So nobody was hiring bond traders. So I kind of fell backwards into this business. Having said that, I've really enjoyed it and loved it. I think there are two schools of thought, and each one is equally quite good, actually. There's the one route, obviously, trying to come in through a bank and learn and understand the derivative business, because there are a lot of facets to it. We think about all the financial aspects that have to be priced in and accounted for, as well as the regulatory environment. It's a great learning experience to understand the regime with which we have to operate, and really honing your skills to participate in that environment. The subject matter is a bit more involved when we think of the option space and some of the other structured products that arise because of that. On the flip side, and I kind of did this actually somewhat again, also by fault, is the physical route. Because after all, as we mentioned in the beginning, and certainly to Michael's comments, the physical is where the rubber meets the road in terms of what's really going on from a risk management standpoint. So if you have the opportunity to learn how the physical world, whether it's oil or agriculture, anything, frankly, in the commodity space, base metals, you're invariably going to come away better off than you were before, because you understand how operations then factor into the pricing environment. And that's exactly what we're seeing today. This is an operational event, an unfortunate one, but it is an operational event which is then factoring into this price regime we see now.
I see. Okay. And what's changed over the years? I mean, there's obviously a much greater shift to renewables that's happened. I mean, has that changed the market considerably?
I think it has, because you must approach everything with a lens of asking yourself that question: what do we think about this from a climate perspective? How does this help? And certainly it has aided the development, much to perhaps Europe's somewhat gain in all of this, is the advancement of climate initiatives in Europe. It will help them get through a fair bit of this because of a lower reliance on some of those fossil fuels. In fact, many countries, Germany, one of them, Spain, I think a second one, are already setting records for this time of year from a renewable production standpoint. So when we think about it from an investment bank standpoint and how we interact with our clients, yes, we now have to approach everything with that climate lens. And then it's fair to ask yourself, well, is it better to look at it this way? Is it better to consider it from a renewable perspective? What are the carbon impacts of what we're doing? And then when we come back to a gas and oil question, we then also have to ask, what is the consumption or the negative contribution of this CO2 action that we could be taking? And we have to factor that into our modeling and our pricing.
Okay, so maybe shifting just back to today, and in this slightly, extremely volatile environment. I mean, there's some stories at the beginning of, I think this was more people trading physical oil, people sleeping in the office and so on. I trust and hope that's not been the case for you, Chris. But can you give us a picture of what it's been like, and how frantic is it?
Yeah, it's incredibly volatile within each day, and certainly it's very headline driven, if for no other reason other than a Trump tweet here and there, right? But it's the unpredictability of it, and it's the backdrop against many questions of where we could go. Insofar as shocks and where we are in my experience, I think this is very much like COVID, but in the reverse, of course. COVID, you obviously had too much supply. Here we have questions about not enough supply. So we have to get to those pricing points that try to equilibrate a bit of that supply and demand profile. So we're getting to these notions. It results in it's a much longer day recently, that's for sure. I have not slept in the office, nor do I want to, but certainly the days are a bit longer. And you find that you have to make yourself available to many different news sources, because there's so much different stuff coming out, and parsing through what's real, what's not, what's effective and what's not is increasingly difficult, to say the least.
Yeah, I can well imagine. And do you think there's any sort of long-term impacts, or maybe it's too early to say, on how the market trades from all of this? Or is this just a sort of an event that we'll sort of process and get through and then sort of go back to normal?
Yeah, that's a great question, and certainly one that we've posed to each other in some of our chats and with other mediums of discussion. So personally, I think it will lead to a higher for longer environment due to the fact that this kind of scarcity feeling is very uneasy for people. It's different than the feeling we had with COVID. Nobody was overly scared. We just had a situation where we didn't have enough storage. Here, we have the reverse of that, but then there's also the notion of, well, what if we run out? And that drives people to act in different ways. So I think you're going to see a development of additional long-term storage assets, most certainly in Asia, if not additional assets, I think, in Europe. The US is likely to be fine in the sense of the asset it has is large enough because they can put more back into the strategic reserve. But I think it's going to result in a bit more of a careful, longer dated approach of having surety of supply in each country by those regulators and by those leaders.
Okay. And Michael, perhaps the same question to you. What's your perspective on this? Tell us what you've been discussing.
I think it is a bit early to say, but I would agree with Chris in the higher for longer thesis. If only because, there is that need to re-inject into storage, and we've already had announced a record release for the IEA. In the near term, and speaking kind of 3 to 6 months, the possibility of a longer disruption would definitely start to raise questions about the possibility of a global slowdown, economic slowdown, that could, spread across everything really. And then there's also, how do countries look to kind of shelter themselves or make themselves more resilient to this kind of shock in the future? We already talked about how it's affecting Italy's planned shutdown of coal-fired generation. Could countries invest in more oil storage? Quite possibly. There's a wide variety of things, really. And then in the Middle East, could there be more investment in pipeline diversion or other means of diversion away from the Strait? There's still lots of questions about, who controls the Strait going forward. But I think we're really only just at the start of kind of medium-term responses, and we don't really know quite yet how wide those could be. And I think the intensity of those efforts to, as I say, to make oneself more resilient will probably also depend in part on how long this goes on.
Mm-hmm. And the storage issues is, we talked about, so-called releasing reserves and storing all. I mean, but it's quite complicated, isn't it? There's, you need to find somewhere to store all of this oil. It's not so simple to put in and take out. And I think I'm right in suggesting that the reserves were not necessarily replenished after they were previously drawn down. But you would expect people to sort of look more at that for the future, would you?
Yes, definitely. I mean, there are lots of kind of intricacies really around these SPR facilities. And you're right, President Biden's withdrawal in 2022 was not fully replenished. There are some indications from the Energy Secretary, Chris Wright, that he would like to make that exchange of oil be reversed quite quickly. To my recollection, I think it's by September 2028 for the first tranche. But there's all kinds of questions around what that means going forward. I mean, one interesting thing is that, a lot of these salt caverns that are part of the US SPR are not designed for infinite numbers of injection and withdrawal. I looked at the facilities and the some of the facilities max out at 5 withdrawals.
But that's because they wear out, right, or something. That the sort of you just
Yeah, I believe it has to do with the degradation of the integrity of the salt cavern itself. And then there's also this issue about geographic distribution of the SPR releases. We talked about 86% of the Persian Gulf exports going to Asian countries, but actually 74% of the SPR release is in the Americas and Europe. And then also there's a big time discrepancy because, you can't withdraw from these facilities at 14 million barrels a day. You can probably withdraw perhaps around 2.5. I think if we're optimistic, 3.5. We don't know exactly how quickly, but it's certainly not 14. And so that means that the first tranche of this withdrawal could probably last until September, November this year, even if we're just compensating for a 1-month disruption in the Strait. So there are lots of complexities to it, but it's certainly not a one-for-one kind of replacement for what we've lost.
So we're back to the almost impossible task of gazing into our crystal balls, and I guess it's impossible to say where this is going to go. There's so many factors and things that are way beyond our control. But what are the scenarios that you're looking at? That's maybe the best way to sort of answer that.
So we've talked about kind of 2-month, 3-month, 2-quarter disruptions is kind of the scenarios that we're looking at right now. And in reflecting that or kind of comparing to that, I think it's quite impressive that as I left my desk, the Brent price fell below 100. We'd be thinking about an 80 to 100 Brent range to account for a 1-month disruption. And it's already been a month. And so a 2-month disruption we would have thought could be within a range of 100 to 120. So I think a Brent price below 100 is certainly expressing quite a lot of optimism about how quickly this could get wrapped up. And, and it may not be necessarily a direct reading of optimism. It certainly could be around, the positioning that has gone into the market in advance of this. But yeah, it's very difficult to say right now. The worst case, at least that we've considered so far, is a 2-quarter disruption. And in that case, we could see Brent prices, I think, going above 170 for the third quarter. But yeah, I think right now the market is very much not looking at that, however, of course, and thinking that the kind of political and economic costs that the U.S. is facing are likely to push it to want to seek an earlier conclusion, if at all possible.
Okay. Yes, I think I read that the famous U.S. gas prices going above $4 a gallon is usually seen as a pain point, isn't it? Fantastic. Chris, anything on the crystal ball gazing from you that you add to what Michael said?
Yeah, I think the key difference between this shock and certainly the one we saw in the 70s was that in the 70s, the only recourse was demand destruction. And I think we'll have a little bit of that here to help balance on the edges. But of course, we know so much more now about what's possible with renewables. And I think our ability to manufacture them is most certainly faster than we're probably led to believe. As a case in point, Germany launched 2 floating LNG terminals during 2022 in about 7 months when nobody thought it could be done. I think the original estimate was 15 to 20 months for just one.
That was to replace Russian gas, right? Yeah.
Exactly right. So the capabilities to do that are really, really impressive when it needs to be. And so now that we know what the capabilities are with renewables, particularly solar and wind, the ability to construct more of those, and probably you'll see regulation from a European perspective aim to fast track more of this. I think it means a more than likely possibility that there's less stress on the gas system a year and 2 years from now, and perhaps less reliability. And then, of course, I always come back to this, when I talk to other people, is the oil minister for Saudi Arabia over 25 years ago said, the Stone Age didn't end because we ran out of stone. We will definitely end the oil age before we run out of oil. So people will find a way.
I think that's a very positive and optimistic note to come to an end on. Thank you both very much. Just before you go, we have our traditional question at the end of the podcast where we ask for one thing that you're dedicated to in your daily life. Chris, why don't I turn to you first?
Right. Well, this is a great question. So my wife and I take a keen interest in single mothers and disadvantaged children. So we try to help out there. We do help out certainly with a charitable gift to a number of organizations in and around London for the purposes of young adults who are sleeping on the streets, to give them a room for a month at a time, as well as single mothers with children through some various charities in London. So that's kind of our focus for the last 2-3 years now. So yeah.
Excellent. Thanks a lot. And Michael, we heard from you because you were on last month that you are having recently relocated to Singapore, trying to be dedicated to keeping up your exercise. So how did March go? Was it as volatile as the markets?
Fortunately, I've been able to keep up a certain amount of routine in my kind of running practice, and even managed to become the most frequent runner on one of these Strava segments. I'm not going to say exactly where, but it's outdoors, and maybe a lot of Singaporeans prefer to run indoors at the gym. That could be the explanation, but yeah, keeping it up.
Well, there we are, a true local legend. Thanks very much, and thank you both very much for joining us on the podcast. And thank you for tuning into This is Deutsche Bank. If you enjoyed this episode, please do subscribe or leave us a comment, and let us know what you'd like us to cover in any future ones. We'll be back soon. In the meantime, take care und bis bald.
This podcast has been produced by Deutsche Bank and may contain research as defined in MiFID II. The information discussed is believed to be reliable and has been obtained from public sources believed to be reliable, although Deutsche Bank makes no representation as to its accuracy or completeness. Opinions, estimates and projections discussed constitute the current judgment of the speaker at the time of recording. They do not necessarily reflect the opinions of Deutsche Bank and are subject to change without notice. For further important information, please visit research.db.com.